The theme of our today's event is IFRS at Crossroads, because we're crossing the road from financial reporting and there are regulatory demands, and the banks have to manage their P&L, their profit and loss accounts. We have to manage capital demands. We have to manage expectations from the outside world. How do we respond to improve the safetiness in our markets?
So there's a need to come up with accounting standards that address banking risks and the risk models of banks. But it comes into conflict with the way that banks operate, because about the only thing that banks have in common is the name bank, but their business models aren't common. And how to steer through that and find accounting standards that will reflect that. And then through that, obviously, it makes them complex, because you're trying to address a myriad of things and a myriad of different business models.
It is quite essential to determine how we do account and report for financial transaction in the banking industry. We have to find the right balance between the right measurement, the right classification. There were concerns during the last financial crisis that we do too little too late. So in this new standard, we have to find ways of accounting for provisions on an expected loss basis. That means we slightly, gradually build up provisions to be prepared for when a loan defaults, rather than having low provision level and suddenly when the crisis comes, there is an increase in provision which leads to turmoil in the banking services.
So our role as the accounting experts group is to look at accounting standards and see to what extent they affect banks and to what extent they address the risks within banks and the impact that it can have on the capital adequacy of banks and the risks.
There is only so much a reporting standard can achieve, and I think we have in the past received unfair objectives to financial reporting. Financial reporting cannot take care of cyclicality. Financial reporting standards cannot improve economic situations and so forth, but we can contribute to stability by adequate reserving levels. We can contribute to fair assessments and investor opinions in the markets through better reporting and disclosure. So in that respect, I think the financial reporting standards are doing their share to make this a better and safer place financially.
Clearly, there are many topics that require further debate. I don't think anything has been settled, but certainly it is raising issues that a lot of us are aware of. And through these type of interactions, it can possibly have an influence on the outcomes. But I think it's very positive, but they are addressing very complex issues.
For the last 2 years, we are actively debating and contributing to the development of new reporting standards, mainly for financial instruments, but also for consolidation and other purposes. So I work together with very experienced colleagues throughout Europe, from other banking associations, and with the Accounting Standards Board, the EU Commission, EFRAG, and other colleagues in the supervisory environment.